Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Troilus Gold Corp. Please note you can submit questions in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Justin Reed, CEO and Director of Troilus Gold Corp., which trades on the OTCQX Best Market under the symbol CHXMF and on the TSX under the symbol TLG. Welcome, Justin.
Hi, thank you very much for the introduction. Good morning, everyone, from Toronto. My name is Justin Reed, and I'm the CEO of Troilus Gold. I'm going to spend the next half an hour talking to you about one of the largest developing copper and gold assets in Quebec and in Canada. As you can see on the first slide, or our title, that's a past producing mine. Troilus operated for 14 years, produced 2 million ounces of gold and 70,000 tons of copper. We've done significant work that I'll walk you through as we move towards a rebuild of the asset after 5 years of detailed work. We will be making forward-looking statements, and I encourage you to read our disclosure. But where are we going to start? Troilus is located in north central Quebec in the southern James Bay. Quebec is one of the best mining jurisdictions in the world. Security of tenure, availability of capital, reasonable permitting time, and a long history of mining excellence, both from infrastructure, skilled labor, and government participation. Unlike a lot of assets that are developing, we're a brownfields project. So we've inherited a significant amount of infrastructure, which we have upgraded. And that's ideally going to keep our capital intensity low as we move forward. We have a robust mineral resource. We've drilled almost 350,000 meters over the last 5 years, huge program. We have 11.2 million ounces equivalent in the indicated, and about 1.8 in the inferred. And when I say equivalent, for the context of this presentation, think 80% gold and about 20% copper. Feasibility, our final engineering is almost done. Our team has done this before, and importantly, we are an ESG leader in Quebec and have kind of set the stage for the junior mid-tier companies moving forward. We have about just over $5 million in cash. We have a large tax refund coming in shortly, and we have a number of cash options or deals that are moving forward with rental of our space, and so we're well funded through the year. We're about $135 million market cap, and we have 277 million shares out. We're well covered by the street. We're about 70% institutionally held, of which almost 20% is the Quebec government. Management and insiders own about 8% of the company, and of which I'm the largest shareholder. So we're about 20% retail held, and I think a key piece of our success over the last few years has been our institutional ownership, as they've provided availability of capital for us. We're located, as I said, in central Quebec. We're serviced out of Chibougamau, a town of 8,000 people, which is a resource center known for mining and forestry. Quebec is a pro-development area. Geologically, and I won't spend a lot of time on the technical geology discussion. However, what you can see on this slide is the Abitibi. The Abitibi is one of the most prolific gold belts in the world. Over 30 million ounces has been historically produced via dozens of operations. Troilus is located in the north of this slide in the Frotette Evans Greenstone Belt. the same rocks, same metamorphic grade, and same aged rocks as the Abitibi. There is a fall line in between the two, which is really the mark of the end of the glacial till. So we are buried, and as such, a lot of our exploration has been really geophysically and geochemically focused. Whereas in the Abitibi, historically, it is you can touch and feel the rocks. There's a lot more exposure. So historically, the exploration dollar has been focused on the south, providing opportunities in a modern era. You can see the past production operated for 14 years between 96 and 2010 by Inmet Mining. It shut down for economic reasons and really corporate reasons, as Inmet focused all of its dollars into South America or Central America at Cobre Panama and into Spain building La Cruces. As such, Troilus was a low-grade bulk tonnage asset that produced successfully and profitably for 14 years and ran out of reserve. The real thesis when we bought the asset privately and took it to market was that it's not that Inmet had done bad work. Inmet really did no work. Corporately, their focus was elsewhere. They didn't invest money into the resource. They exploited their reserve, and they never invested money to see if there was more. Inmet was hostily taken over by First Quantum for their other assets, and this mine was put on care and maintenance and eventually started to reclaim. You can see the two pits which are flooded. 87 is down to about 300 meters, J4 about 120. We have completed all of our environmental studies for dewatering. There's 30 million cubic meters of water. We've purchased all the pumps and barges required. We have our environmental license to dewater, and we've done some test dewatering, and in the spring we'll start the whole process. Our focus as we've drilled, and I'll start showing you in a few slides, is we've really started originally exploring from the main assets and worked out structurally away. And what we saw is that the mineralization is not contained within one rock type as previously thought. It's really structurally controlled. Large bounding faults and cross-cutting faults that control the flow of these metal-bearing fluids. And the moment we changed our exploration model to a structural one, we've had some great success that I'll talk about. In September of 2020, so over 3 years ago now, SRK priced out our infrastructure, our replacement value at about US $350 million. You add today's inflation onto that, is probably closer to $500 million US. We have 40 kilometers of roads off of the main highway. There's no fly-in, fly-out here. It's road accessible, about an hour and a half north of Chibougamau. We have 60 kilometers of power line and 171 kV feeding our 50 megawatt substation, all of which we fully upgraded. We're going to get grid power at about 3.2 cents a kilowatt hour. It's hydroelectric, it's clean, zero carbon. We have a 100-man camp, and we have the sites cleared and the infrastructure for a 1,000-man construction camp and 400 to 500-man operational camp. A lot of the earthworks are complete and the civils are complete that would be needed for a restart. And then ultimately, and I think most importantly, underneath these pictures, you'll see our tailings facility. It's 6.5 square kilometers of fully permitted tailings. And that is probably in today's dollars over a 300 million US build. We have life of mine capacity when we consider lifts, and also in-pit disposal, and is fully permitted. So in this world of environmental scrutiny, the fact that we have our tailings in place, permitted, and continuously monitored by the government, it puts us in good stead. This is going to keep our capital intensity low. This is going to be a huge operation. Our feasibility will show a 25 to 30 year mine life at 35,000 tons a day, producing over 300,000 ounces of gold a year, between 20 and 30 million pounds of copper, and about 1 million ounces of silver. So here's our resource growth. When we took over the asset, you can kind of see on the bottom left-hand side of your screen, we had just over 1,000,000 ounces, about 1,000,000 ounces under the 87 pit in a very tight, well-defined ore body, very similar to Agnico's Goldex deposit, and some displaced mineralization under the old J pit. We have drilled over 322,000 meters. We have drills turning now, and we've, over the course of 5 years, and as our model refined, we've been able to grow that resource substantially to 11.2 million ounces equivalent of indicated and 1.8 inferred. This is one of the largest developing gold assets in Canada now, and I'll have a slide to talk to you about that. This should start spinning shortly, but here is a 3D view of the assets. The more we drill, the more we find. We now have that 13 million ounces is spread out over 4 main deposits, 87 JX22 in the southwest. There's a zone called the Gap in the middle. Ultimately, the pit shells are being pushed down below 500 meters. And I'll go to the next slide now. I have a better slide in a second to show you that to you and talk about a few other key points. But again, here's our growth. As our model defined, and the more we drill, these type of deposits require a huge amount of drilling. And we've had over a 98% success rate on our drilling. We certainly have enough now to warrant moving towards feasibility, permitting, and moving towards a construction decision. With more exploration, this deposit or this belt certainly could get a lot bigger. This is one of my favorite slides because it kind of shows everything in its distribution by zone. One of the key advancements that our team made, run by Kyle Frank, was that X22, 87, and J over the last year have formed into one super pit. What that has done is it allowed far easier accessibility to the ore. It's lowered our strip ratio significantly, and it's identified areas of higher grade which we can start the mine at. And at the south end of 87, parts of X22 and the connector between J and 87, we've identified zones of materially higher grade that we will feed through the mill early. And in these low-grade bulk tonnage deposits, your whole objective is to pay off your invested capital as fast as humanly possible, drop the cutoff grade, and push tons, just like you see at Detour, like you see at Malartic and others. And that's the model that we're following as well. We have 1.5 kilometers in the gap zone between. We have drilled there. We've hit economic mineralization, and we believe that the opportunity for those to connect is there in the future. Again, here's our resource growth. And this shows the distribution of drilling. You can kind of focus in. That was our 2020 resource of 8.1 million ounces equivalent, 2023 of 13 million ounces equivalent. And you can see the expansion of the Southwest to over 2 million ounces. That was a brand new discovery 3 years ago. X22 was a brand new discovery as well. That's turned into 1 million ounces in over 1 year. And the gap zone has shown that these really stacked ore bodies have continuity throughout the gap, and we are actively testing those now. To the northeast, which is the right of the page, you will also see some drilling, and we've had some great hits out there. So Troilus is a work in progress. It's a huge resource now moving towards development, but certainly we look at it as a generational scale asset. And here is a couple different cuts of the growth between 2020 and 2023, and I'll just maybe focus on the second panel down. You can see in 2023, the Southwest was very small. In 2020 and 2023, it's expanded significantly. And also you'll see that we've added the X22. So a lot less gray, a lot more color, which is economic mineralization, lowering the overall strip ratio. And the third panel down, you can certainly see how X22 fills in that whole left side of the pit, which allows us, again, to move less waste and more economic material. So now I'll talk about some comparisons just to put things into context for you. So here is a chart, a graph of, I call it the developers and the dreamers. This is every resource in Canada that is under engineering and permitting and or under construction. And as you can see, Troilus is the second largest behind IAMGOLD's Côté, which will be pouring gold shortly. We're building a mine very similar to the scale that Equinox is right now at Greenstone. And I think what I'd like to do, just from a valuation opportunity standpoint, is compare ourselves to Artemis. The Blackwater deposit's been well known for a very long time, originally from New Gold, and then Artemis bought it. And I think we're just a little bit bigger and a little bit higher grade. Artemis currently is a $1.3, $1.4 billion market cap. We're a $135 million market cap. And when you look at a life cycle of a mining company, a lot of people talk about the Lassonde curve. I talk about de-risking events because we are not an incredibly high grade, but we're a very large deposit. So it's about technical de-risking. Artemis bought their resource from New Gold. They updated the feasibility study. They put out their EIA. They got fully permitted. They put in their project funding, and they are. This is 45 as of yesterday. They were 65% done their construction. They've completed a significant amount of de-risking events to add value as they move towards operation. We have spent the last 5 years discovering a new asset, essentially. We have drilled, like I said, 325, 350,000 meters, actively drilling now, getting our resource 3 or 4 months ago to where it is now. We've been permitting for 8 months. Our EIA our detailed project descriptions are in, both with the provincial, federal government. Terms of references are done. Consultations are complete, and our EIA will be submitted in the middle of the year. Our feasibility will be out very shortly. We're working on project financing now. We expect to have our provincial and federal permits in place in the beginning of 2025. I guess we're 2024 now, and hope to be in a position to start construction towards the end of next year. And when you think about that, that's an 8-year period of defining 13 million ounces equivalent, engineering, permitting, funding, and moving into construction. The major de-risking events that moved Artemis to the market cap they are now, besides the fact that the team has done an incredibly good job there, we're going to deliver over the next 12 months. And in a very strong gold market, which I think we have, and the fundamentals are setting up even better, I think the Troilus is set to deliver those de-risking events and value creation events over the next 12 months. We also have a very large land position. We have 500 square kilometers. We had 15. We sold 1,000 square kilometers for $50 million a couple of years ago, and we've been funding the company on a non-dilutive basis since then. We did a small raise in November. We have a number of key exploration areas within the belt. These are focused on higher grade opportunities. Troilus doesn't need more ounces, but Troilus would love some higher grade material. So we have a very focused exploration plan this year on a few core areas down in Palador and Testard. And that will keep the news flow coming as we engineer. The team has done it before. Ian's built a number of mines. Daniel Bergeron was part of the Eleanor construction team of Gold Corp in the northern James Bay. Jacqueline Leroux has permitted a number of mines throughout Quebec and is very well known for that. Our board of directors, I'll just really focus on Eric Lamontagne. He was the last superintendent of Troilus. has built 2 mines for Agnico, and he's currently building the Greenstone asset, for which we're actually replicating our scale and our scope. So the engineering work that we're doing now, we're getting real-time data and guidance from a mine that's being built. And then in this inflationary environment, it's absolutely key. And so we have everything we need. So I kind of laid out the milestones, but you're going to see our initial reserve and our DFS out very, very shortly. We have a 25,000 meter drill program this year that is looking at some low-hanging fruit at the actual mine, and then some regional exploration. Our EIA will be submitted in the middle of the year. Our permits will be flowing through towards the end of the year and into early next, and we're working on the construction financing now. So it's going to be a very, very busy 12 to 14 months for Troilus. ESG, and we should talk about it first, not last, but when we formed the company 5 years ago, our senior VP, Catherine Stretch, and our team identified ESG as the major focus of extractive industries, especially from financing, social responsibility, and management frameworks. And we put a full team in place. We were the first company in Quebec to receive our Ecologo certification. We're working with Tuklik Energy out of Quebec right now to look at how we can produce a zero carbon emitting operation, looking at an alternative power use in the future. And as well, we're the first company under $1 billion in the extractive industries to become a UN Global Compact member, which is a hats off to the team. We work with the absolute best practices, and this is going to be incredibly important about maintaining our cost of capital when we go to fund. So lots of catalysts coming. We're in a great jurisdiction. The Quebec government is our largest shareholders. This is a brownfields operation, so we're not reinventing the wheel. We're not being overly innovative. This is grassroots open pit mining. We're large and scalable in a time when copper for the electrification of the world is becoming incredibly important. It's a critical mineral. And gold, obviously, is an inflation hedge and a store of value. This deposit is going to be generational in scale, and we're excited to get it to the market. So with that, I'm gonna stop the presentation. I'm going to jump back to one slide, just because I always like to sit on this slide. And I got to go back a couple. There we go, this one there, right there. Because a lot of questions, usually this is a slide to refer to. And I'm going to address the few questions that we have in the queue to wrap everything up. So the first question was, how did we acquire the project, and why did the prior owner walk away? And get that question a lot. So the prior owner walked away. Inmet operated this mine and ran out of reserves. They hadn't invested any money into finding more. But they had Cobre Panama, which right now is the 6th largest copper mine in the world, is shut down because of social reasons after over $7 billion had been invested. And they were a base metal company. And so they were taken over hostily by First Quantum, which is the 2nd or 3rd largest copper producer in the world. And when First Quantum kind of looked at all the assets, they saw there was this Quebec asset. It was on care and maintenance. There were no reserves left. The gold market was not strong, and the U.S. dollar or Canadian dollar was very weak, or Canadian dollar strong. And so from that standpoint, they just decided to shut it down. And the market went elsewhere and kind of forgot about Troilus, and that was the opportunity for us. That's why they walked away. I was a mining analyst at Sprott Securities and Cormark Securities. I've worked in the mining business before that with majors, and I covered Inmet. And I'd been to the asset a number of times. Our team knew the asset as well, and we always wondered why the mine was so undercapitalized. And again, it's not because Inmet did bad work. They did no work. Money went elsewhere. And it just provided a huge opportunity. We went in and negotiated a purchase privately via an option agreement. And then in 2018, we bought it out and came to market. But that's a great question. It was just kind of an underloved, ignored asset at the wrong time. A question from a good friend of mine in Quebec. Could you speak of your good relations with the First Nations of Mistissini, historical labor expertise, social license, etc.? That's a great question. This comes from a well-known mining analyst. The first IBA, Impact Benefit Agreement, in the James Bay, or under the James Bay Accord, was INMET and the Cree. And so that is an agreement which sets out the cooperation and economic sharing. It was an agreement that was in place for 14 years. It targeted economic contributions, and about 25% of the labor at the mine was First Nations. We have signed an IBA, or a pre-development agreement with the Mistissini Cree, and we inherited a lot of that goodwill. And over the last 5 years, probably 20-25% of our labor at site have been Cree as well. What's great is that we've inherited, unlike a lot of other jurisdictions, both provincially and globally, where you see social tension and strife, we inherited a 14-year successful relationship that was really win-win. And so we're essentially establishing a continuation of that, and our First Nations partners are doing the exact same thing. So we inherited a really good starting point. As far as historical labor and expertise, Chibougamau is a mining camp. There are a number of mines around. There's a ton of skilled labor. And when Troilus shut down, all that labor still lives in Chibougamau, but they moved to other mines. Troilus is a drive-in, drive-out. There's no fly-in, fly-out type of operation. It's the closest industrial complex to the major center. And as such, we'll be able to deliver a far better work environment in such shorter rotations, more time with family. And so I think we're going to be able to lure a lot of that past labor back. That was a good question. Could I speak to the regional exploration upside? Could Renault be a source of high-grade feed? They're anticipating Renault to confirm a range of 1.6 to 3.2 million ounces. So I didn't really touch on it. Down by our Palador property in the south, kind of where Route du Nord turns into our mine road turns off, about 40 kilometers from our mine on the main road. Sumitomo and Kenoraland, and now it's 100% Sumitomo, discovered the Renault deposit. It was almost 30 meters of 8.5 grams. It's a narrow vein, more Abitibi style, structurally controlled mineralization, actively being drilled right now. We have them completely surrounded. They're drilling almost up to our boundary, and we see a lot of continuation. At the end of the day, we have the power infrastructure. We're going to have a very large mill. 100% as Sumitomo moves this forward, and they're at the very early stage. That high-grade feed could easily feed to Troilus if a deal could be cut. And I think if the infrastructure is paid for, it's a lot cheaper just to build a shallow underground operation, and then drive the road, or especially at that grade up the road. So lots of opportunities for that in the future that we'll be talking to them about. A good question. What do I expect the grade per ton to be for the first 5 years? And I'm glad I'm on this slide. Our goal is for the first 4 to 5 years to be at or above a gram. And, that is going to provide higher grade through the mill, expedited repayment of invested capital, and we have those areas targeted. If you look at the large, call it comparable operations, Detour is running 0.5 gram right now, Malartic's running 0.5 gram right now. So for us, repay your capital as fast as you can, and then drop your cutoff grade and push the tons. The most profitable mines in Canada right now are Detour and Malartic for that very reason at those grades. Have any elements, and then I think this is my last question, and time's working out. Have any elements in the CapEx actually decreased since the cost of PA? The PA is really an irrelevant document. I mean, that was 3 years ago. That was pre-inflation. Nothing has gone down. In fact, even in the last 12 months, we've seen over a 20% increase in a number of capital items in the last 12 months. So if you look at Cote and you look at Greenstone and all these other big developments underway, inflation is real. We've seen a 22% increase in concrete over the last 12 months. Steel is beginning to level out and might start dropping, but since the PA, nothing has come down. Labor is up almost 40% as well. So this can be a large capex, but long life asset that's going to give a very good return. What we also have is, of course, the gold price as well. So I am 40 seconds over. I'd like to thank everybody for their time today, and my entire team and I are always available for